Hello, YouTube. Today the FOMC talked and the market moved. What happened? Well, a whole bunch of nothing from the open and the close because the open is 425.91 and we closed at 426.64. I'm noticing a pattern that is setting up here on the daily chart as well, and we are resting right around daily key areas. What am I talking about? I'm talking about this right here. We have a red line at roughly 429.6. What's our high of the day? 429.5. That is basically a head and shoulders versus the price that we had on Monday. It's a little bit more evident if we look here at the hourly chart, and we could just zoom in here to identify what's going on. Ignore the lines. Those are just support and resistance here. So resistance for me on ES, which is the SP500, was here at 43.03. And now that we have a left shoulder, or the left side of the pattern, we have our head, and then the right side of the pattern, what it shows me is that we're now currently a little bit stuck. And we're stuck between roughly 4,300 and roughly 4,250. That's about a 50-point range, or roughly 1% to go from the high to the low. And this is just important because I'm watching the reaction. So we went all the way down. We went down, 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 nice and steady on CPI numbers out of Europe and GDP numbers. We snap all the way back up and reject immediately. So for me, what is that? A dead cat bounce and a rejection, resting right back on the VWAP, 42.78. So as we're now looking back here to our daily chart and we ask ourselves, okay, well, what does that mean? Is there more data on the chart? There is. We also had a test of the 200 DMA. So testing and poking the 200 DMA would be the first progress towards claiming it. All right, cool. Next data point is that we gap down, pumped up, sold off. So we have a spinning top. But we did actually close about roughly 70 cents higher than we opened. Volume is on par. And that tells me that from the open and the close, people were roughly equal or neutral, and they didn't buy or sell more than normal. So this kind of means that objects in motion tend to stay in motion. So again, if we look back to what we were looking at as our dominant pattern right now, we have a yellow box. The yellow box identifies areas of congestion before we ultimately either went higher or went lower. Back in May and June, we had our coil get tight. It shot down with double gaps, one here and one here in early June. Now, on the flip side, as we're forming our cup and handle, let's draw the proper cup. There's our handle, and then there's the break higher. What do we have? Well, we have an area consolidation. Coil gets tight. It shot up, and now it's meeting the first level of resistance between 430 and roughly 435. Again, another way to look at this would be here on the weekly chart. So we're down by about 46 cents. And I think that when we look at the Fed meeting minutes in a moment here, it'll be important for us to try to decipher what this actually means. What do we have here as well? Well, we have 433 as our 50 weekly moving average, which means we got within almost 1 point of making it to the 50 weekly. And as of right now, we've closed below it. What I would want to see to remain bullish on this uptrend, because there are higher highs and higher lows. For the longest winning streak, going back to November of last year, we have low, higher, low, higher, low, higher, low, higher, low, higher, low. We got the high, higher high, higher high, higher high, higher high, higher high. That is 5 back-to-back weeks with higher highs. If we're able to close above last week's high at 427.21, I would say that that's good enough. Price discover on week 1, claim it on week 2 or 3. Still need vol though, send vol. But we know that we're getting into the dog days of summer, where there's roughly 2 weeks left to Labor Day. So sell in May and go away and come back on Labor Day. What would have happened if you would have sold in May and come back? You would have sold at 410, would have avoided 50 points down, and you would have missed out on about, as of right now, 16 points higher. That kind of seems like a winning strategy. Maybe people realize now why the Hamptons exists, because not every day is for trading. And I think today was one of those days where people might have gotten a little bit chopped up. So why? Well, I think there's 3 types of markets people have to be mindful of. There's a bull market, which means we're going up. There's a bear market, which means we're going down. And then there's the kangaroo, which means we're going a whole bunch of nowhere, right? Chop, 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 chop. Bulls go down, bulls go up. I believe we're going to be entering a kangaroo market if we don't get a clear, decisive break by Friday. Why? We now have areas of liquidity where bulls and bears are both going to be positioning. And again, we're now going to look at the Fed meeting minutes here. We got Many participants remarked that in view of the constantly changing nature of the economic environment and the existence of long and variable lags in monetary policy's effect on the economy, there was also a risk that the committee could tighten the stance of a policy by more than necessary to restore price stability. What does that mean? They're scared of doing too many hikes. That's what this means. And we now look at the flip side. So from the Fed meeting minutes to Fed Bowman, who spoke this afternoon, from the minutes, we hear officials saw risk if public questions Fed's inflation resolve. What does that mean? This is called a soft landing. They have a very narrow path to get on to get to that soft landing. They over tighten, that's a problem. They don't tighten enough, also a problem. So Fed's Bowman, some retirees may feel compelled to return to work due to inflation. Who votes? Well, we know it's not the millennials, it's the boomers. So this kind of also really matters as we're going into the midterms in a few months here in November. So we have to also remember that meeting minutes are going to be backwards looking, which means we're looking at what people said a month ago. What's more important for me is the reaction to what happened to the minute. So I would have expected that as we approach 43.03, we would have rejected. Happened here, we backed off, built up steam, finally got through it. And then today, as soon as we hit it, we backed off, tried for a second time, rejected the 50 MA this time. So that's where we found the resistance. And now we're just watching for our previous top. I would also note that, there is an inverse head and shoulders pattern setting up, but I don't think there's enough time on the right side of the pattern as there is on the left quite yet. So it's possible we could form one. It just kind of looks like it's, a dip, a slow drip, 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 drop. So again, drip, 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 dead cat bounce, drop, bounce, but it failed because we rejected right at resistance and then right at the 50 MA. And now we're just watching the VWAP versus 42.82. Not really all that complicated, but it provides some context in terms of what the market digested and saw as the catalyst. What's more important for me is what Fed officials have been saying more recently. And in the last week, we heard from, again, the headline here just says, Fed leaders unswayed by softer CPI, see rate hikes into 2023. Remembering that the last meeting is when Jerome said we were at neutral. So what are they doing? They're walking it back. The dot plot might be too low. Maybe they will have to raise rates all the way into 2023. If the market's strong and resilient, why not? So we had Kashkari and Evans saying the same thing. From another central bank, we have the Bank of Canada, which yesterday, McClem, who has only published an op-ed or, again, an opinion inside of a paper twice, is now saying that Chief says not done despite cooler inflation. Remember, they raised by 100 basis points at the last meeting. So what does that mean? Maybe the market is not properly reflecting what the Fed is actually going to do. We also have to remember that there's going to be Jackson Hole coming up. And when is Jackson Hole? I think it's 25 to 27. Yes, it is. So we look at dates for Jackson Hole. Summer camp for Fed officials or bankers. It's going to be August 25 to 27. That's in 10 days from today, roughly. So what's going to happen? I don't know, but what the market looks at is, the market is a future discount mechanism. So what the market does is it tries to discount the future. If it thinks that the Fed in about a month is going to be hawkish, what will it start doing? It'll stop going up. It'll break the downtrend and find some level of support. Maybe 410, maybe down to 380. I don't know. On the flip side of it, thinks, hey, well, actually, the Fed already pivoted. Now it's time to get bullish. We should meet our 200 DMA. We should coil up, and then we should break back above, which would lead to what? A second push, just like we got over here on the move down. So now let's look back here on the chart and try to just explain. So this just happened. It was a power move, right? 3 days. Oh my God, the gains were gone. These 3 days right here formed a huge range with volume. So because we don't have the volume to confirm the move, it just takes more time. Couple of bars equals one large bar. So if so far after coiling up, we had 1, 2, 3 legs down, we've only really had one leg up so far. That's our first leg. Are we going to get a second leg immediately? Do we have to consolidate a little bit more? I'm not entirely sure. But I'm noticing that things like Bed Bath Beyond are having really big gains lately. It appears like people want to add the risk back on. And actually, one more thing I want to look at here. Video might be an extra minute or two today just because I think it's important to provide some context. So now that we understand what the Fed said, how the market interpreted it, now let's have a look at if this was just a normal day, what would I be looking at to confirm or deny my bull or bear thesis? Well, first of all, today was OPEX, so it's options expiry today. and we got monthly OPEX on Friday. So I looked here to the chain and asked myself, where is max pain? And where did we close? Oh my goodness, there's like a whole bunch of puts on here. Yep. 426 down to 423. Those all got smoked. They expired worthless. When we look at the call side, oh, right, 427 to 430 is like, oh my God, we're going to have to pay out bigly. Those also entirely got roasted. So the levels that mattered were really 426 to 427. And if we look over here, there's also roughly there's 250,000 in puts here, which means that closing at 426.5 or in between 426 and 427 is where max pain is. That means that they were able to burn the maximum amount of premium. All we have to look at is everything above, again, everything below here worth 0. Everything above here worth 0. So the fact that we closed at 426.65, but in after hours, we're back up here roughly 427. Yeah, that makes perfect sense to me. I'm like, cool, that's kind of exactly what I would have thought happened. Yep. So low volume, right on max pain with a doji. Oh my goodness, what's happening? Well, whole lot of nothing. So the dominant trend is likely what we're looking at. And that's where we now have to look to Friday. Is there any massive divergence between what we see on today, and what we saw for... Actually, one more thing I wanted to point out was just, it's not really that big of a deal. There was massive open interest for today too, which just means that they were extra efficient at burning premium, right? They just burnt it all. They burnt it. What I've been noticing is that there wasn't really a lot of activity for, again, August 19th, which is the monthly expiry, beyond 430. So I kind of saw 430 as being a ceiling, at least for OPEX, and then maybe we'd clear it after. So 430 here, we note that, whoa, right, 427 to 430, woof. Notably, we got open interest here at 430 as well. So that's where the bulls want it. They want it up to 430. And there's probably more all the way up to 435, but the fat numbers are between where we are right now and 430 on Friday. Okay, what about the put side? The volume starts here at 427, goes down to 420, where the open interest is between 425 and 420. What does that tell you? It tells me if max pain was respected today, I would say that removing all this crap on the chart here, I would say somewhere between 427 and 425 is where I would expect max pain. I'd be leaning a little bit more on 425 just because I think the move is going to be a little bit higher in the short term. But for now, they have to massage the chains and then we'll decide where we go. So now if we understand what was really happening, I want to preview something we're going to be launching very shortly here. So this is our platform called the Algo. And here we're looking at options in terms of, again, we're looking at orders that are above 100,000 in premium. We have a lot of data on here, but just bear with me. We are, again, we got roughly 51% put flow, 49% call flow. It's basically 1 for 1. Now what I want to do is I want to look at week to date, the positioning for SPY. Okay, what's the positioning been? Let's sort by premium to see the largest orders at the top. Oh, okay. So we got some puts. Where we got some here for 430 days out. These are all, how many days to expiry here? We're looking at September, October, September, October. And the numbers here are roughly 430, 460, 400, 430. But the premium here shows us that S&P is now, again, looking for, 2 million in premium, 700,000 in premium. Then we got a whole bunch of calls here that are all stacked up. But it's not really clear. S&P has a put flow of roughly 61%, call flow of 39. When I looked at this earlier, though, what I noticed was QQQ. And QQQ is more bullish. So when we look here at the largest orders, let's just sort it by premium here. We're going to note that the largest orders are, again, bearish. So we got some bear ones here. But again, 220 seems like a little bit of a stretch. I don't know why they bought that. It's probably just collecting premium. But the multi-million orders are for, again, puts and puts. Then we got 1 million here for calls. And then below, we got a lot of mixed. So we look at the dials to figure out, oh, okay, it's actually, there's more premium or more flow in calls. And then when we look at week to date for all stocks, and we just sort this by premium, what it looks like to me is just that, again, let's get these sorted by premium here. And we just note that these just look like, right, we look at days to expiry. They're not really all that long dated. So these just look like bets. And there doesn't really seem to be much positioning on the ETFs. It's mostly single stocks like Costco, like Shopify, like Match, like TSM. So for me, what this pretty much means is that, oh, we got some larger orders coming through now too. So it just means that these are mostly like individual stock bets. These are not really anything that really gives me too much confidence one way or the other. And we're pretty much deadlocked here at 1 for 1. So now we note that, okay, we're roughly 1 for 1 on volume. We're roughly 1 for 1 on opening price. We're roughly 1 for 1 in terms of where max pain closed. What does this mean? We're in a neutral market. And we've just tipped into greed and we held it, even with, just tipped back down. It was at 56 when I checked last time. We went to 57, ticked down to 56. Now we're back into neutral. So market is neutral, right around key resistance where support and resistance is both found. Options are basically deadlocked. And now we have to look at, is there anything we need to be mindful of that gives us a warning? Well, now we can look here and just see that, well, there's not a whole lot going on the heat map. If we zoom out to the last 1 week, or roughly when those options are now getting bought, it's pretty mixed again. So, right, Apple strong, Amazon a little bit weak, but generally mostly green. And last thing I just want to look at is going to be a couple of single stocks. A couple of single securities. Want to have a look here at what I noticed today was that energy actually closed up. That's the first thing I noticed. It's the only ETF that closed up. Then I noticed food was doing really well today. So the things we're worried about, inflation, or what was doing well today. Only Apple closed green with them revealing they're going to be launching their iPhone 14, I believe, in September. And then crypto down, right? Notably down too. Down 2 and 1%. And what's more important than this for me is that on the weekly chart here, again, we're rejecting right at a key downtrend. We still have a higher high and a higher low. We're still above our 2018 top, but momentum is waning. And I say that because on the daily chart here, we note that we now have 4 back-to-back red days with what? Massive upper wicks forming, right? 1, 2, 3, 4, 5 massive upper wicks. That generally leads to downside. So crypto generally moves ahead of the broader market too. This is flashing a warning for me. And then the other warning comes from the dollar and then also from treasuries. So looking back here on the dollar, 106.56 is a level that goes all the way back to the 1980s. And since we have inflation going back to the 1980s, it's important to remember where we came from to know where we're going. We can now note that, our uptrends, now we're just going to remove that, bounce off the 50, back above 106.56. This is not good for bulls. Doesn't mean we can still power up and go higher? Sure, but we have headwinds. And then finally, the 2 and 10-year notes went up again today. What does that mean? They're telling us to think the Fed's going to go higher. The 10-year note is just below 3% now at 2.9. And the 2-year note is making a fresh high. The only time it's been higher was at its relative high here in June. These things appear like they want to go up. So although we are in an area where we are deadlocked on neutral, the market is beginning to flash some warnings. What's it going to mean? Where are we going to go? We'll probably have to defer that to find out where we go into OPEX, but then post-OPEX. And that's because, again, we're currently inside of a consolidation pocket where right now we would need to fall below our 420.76 monthly low to break the uptrend. And that would have to happen on Friday. Into Friday, we have to lose another 2% roughly, 1.5% to 2%. Otherwise, going sideways just means we have more time before we decide if we go down or we decide if we're finally going to claim that 200 daily and the 50 weekly. And since we are currently in OPEX week and this monthly chart is now done price discovery to those key averages, I would expect it's going to close right around last week's high if max pain will be respected. And then after price discovering, we advance higher. If you enjoyed today's video, I would really appreciate a thumbs up. And if not, I would encourage you to watch the video that'll queue up here in a moment, which is my weekend deep dive thoughts, which tells you the reasons why we're looking at what happened and where I think we're going to go. If not, thanks so much for watching. Look forward to seeing you tomorrow. Thank you.